Welcome all of you. Good afternoon. Today I will try to just take through the different products, different investment products. I think we have already discussed about several products, several investment products, and we have gone through the nature of those products, the risk return trade-offs and that type of things we have already gone through. But we have to discuss some more products. Some more products, and at the same time I want to just give certain details about the purpose of investment and portfolio management. The real purpose is to have a optimized risk return trade-off for the products, and your role would be sometimes an advisory role or a managerial role, or sometimes you can become an investment personnel, your own investments. That is also a possibility. So therefore, whatever the way, you would be in a position to get the rewards of this course. In order to get the full rewards of the course, you should be in a position to grasp and understand the things, and you should get the skill of applying these things into the real life situations. That is the objective of this course. And at the same time, we have now gone through several aspects of the products, their returns, their risk, and how we can derive an optimized trade-off. In order to do that, I have just taken you through several practical scenarios. If I put it in different forms, now I just took you through the IBSL website, where you got some idea about the different open market operations, the way in which the central bank control the interest rates, and the risk and return factors of government securities, basically. And at the same time, you had a good exposure to the Colombo Stock Exchange website, and I just took you through that operations and the way in which you can devise a certain strategy to invest in the stock market. Not only that, through your knowledge, you would be in a position to advise some investors when the need arises. So these are the basic competencies you would derive from this course. Today, I just try to explain you another type of products. Now, these products basically you need to apply for hedging. What do you mean by hedging? When you invest in some product, you expect a return, and your performance also measured through the return. Not only the return, you need to get the risk adjusted return, because to get any type of a return, you have to expose yourself to a certain amount of risk. But in order to optimize your investment, what you do is you try to see how you can get the maximum return out of minimum risk. That is the trade-off. So if you can do that, and if you can show the investors that you are in a position to instruct them in order to get such type of a risk return trade-off, you would be regarded as a successful advisor. But in time to come, you will realize that whatever the efforts you made, you would not be in a position to reduce the risk to a zero levels. You need to live with risk. So when you live with risk, what would happen is you have to see how you can hedge it. Hedge means you just do some securitization, or you just do some type of technique where you can reduce the the downturn, or the downturn of profits or whatever, or in other words, you can mitigate the losses. So that is what you mean by hedging. So in order to do that, or specially designed for that purpose, there have been certain products. We call them financial derivatives. Today, we try to see and we try to get an overview about financial derivatives. So today's lesson is that. So I think you all can lively engage with the discussion and you can get the most out of it. So I think you have already heard about these products or these derivatives, basically the financial derivatives. And these financial derivatives have a specific purpose. The specific purpose is to help investors in their risk hedging of risk. That is the specific purpose of derivatives. But in the meantime, some interested parties, they try to apply or use derivatives in order to get an arbitrage opportunity. Not only that, some interested parties, they try to do speculation also by using derivatives. But in a legal perspective, those things are restricted. If a derivative is used for speculative purpose, that is looked at a more fishy way, and the legal framework really discourages that. So therefore, you need to see whether you use the derivatives for that specific purpose, that is hedging. Even arbitrage is possible with derivatives, but you need to know what these terms are, what these concepts are. Now I talked about three things. One is the hedging, the other one is the arbitrage, and the speculation. I think in a very short manner, I just tell you those things. First of all, you need to see the mechanism of hedging. Hedging is you try your best to safeguard the investors with potential losses. Safeguard. Now that safeguard comes with a certain mechanism. That mechanism is called the hedging technique. I can just give an example. Say, you want to do an import. You need to import some items from a foreign country. For that, you need to open an LC. When the LC is open and when the goods come, you have to pay for that. You have to pay the bills. Now, when you pay the bills, you have to pay the bills in dollars, basically. The issue is now when you get into the sales agreement, now after getting into sales agreement, you need to wait for about 2 to 3 months to pay the goods, pay for the goods. So therefore, you have a risk, especially we call it the foreign exchange risk, because at the time of your agreement, the dollar rate would be something. Now, nowadays, I think you all agree with me, the dollar rupee rates is very, very volatile. I think in the near, we can say, for about say 70 years, this is the highest volatile period for foreign exchange. Now you can remember now when the exchange was floated on say February 28th, not February 28th, March. In the month of March, the exchange rate was floated. The meaning is there's no restriction on the exchange rate, no official exchange rate. Now it is being decided by the market forces, what you call is the demand for foreign currency and the supply of foreign currency. Now merely on that, the exchange rate was decided. At the beginning, you can remember, it was about 239 or 240 at the beginning. Now it has gone up to 275. I don't know whether it has gone further up. Now you see the point. Now if you want to do a hedge on this, what should you do? There's a mechanism called forward exchange contracts. Now if you can have a forward exchange contract, you can have a hedge. So how are you going to do that? So for example, now if you go to a bank and just ask for a forward exchange contract to purchase dollars. Now when you want to purchase dollars, the bank has to sell dollars for you. Then that is the selling rate of the bank. So then you go to the bank and ask for a forward exchange contract, say for 3 months. To purchase dollars, no, you have to give the amount also. Say you need to purchase $100,000. Another 3 months time. Now today is 19th of March. Say the date would be 19th of June. Yes, June. 19th of June would be the contract date, the future date. So if you go into an agreement with the bank to purchase dollars, $100,000 on 19th of June, we call it a 3 months forward contract. 3 months. And it's a purchasing contract for you, selling contract for the bank. So then what they do is they just take the today's exchange rate and apply a certain premium for that. Then they would say their agreement would be 275 plus something, say plus 10 rupees. So then whatever the foreign exchange rate on 19th of June, you would be in a position to purchase dollars at 285. Irrespective of the exchange rate applicable on 19th of June in the market. So it can be sometimes 290 or 295. You would be in a position to purchase at 275. So that is the nature of a forward exchange contract. Then your loss been restricted. But there's a small thing which you need to know. If the exchange rate falls below 285 on 19th of June, still you have to purchase it at 285. That is the issue. So if that is the case, you would not get an advantage. But you can't really just abandon that. You have to do that. Therefore, it only protects you from the losses. You would not be in a position to realize profits from that. That is the issue. Right? I think you got my point. So that is what you call a forward exchange contract, and that can be also considered as a derivative. It's a derivative. Right. So the mechanism in which the derivative, the forward exchange contract was operated is called a hedging. Now what really happened? If you incur a potential loss through that, that would be curtailed through that. So that is what you call hedging. I think you got my point. So then we can go to the next thing, that is the arbitrage. Now arbitrage is, if you can, arbitrage means you exploit the market. The same good has two different prices in different markets. If you are in a position to simultaneously buy and sell these two things, or this good in these two markets simultaneously, then you would get a profit.
So
that is what you call arbitrage. Yes.
So is it possible to get the note on the screen, sir, while you are
I
going
will.
all right.
I will put it. So I am really giving you an introduction only.
All right.
So
Right.
then the discussion goes on. Then I will put the note on the screen, and because my way is that. So I really don't stick to the presentation. I read the presentation. So that is not my way. So I just give you the details, and I just give you in a very free manner the details. Then we go through the notes. The note is a guidance only. So you should not restrict yourself to the notes, because you can have any type of free thinking. That is why I need. That is what I need. So that is why I have not just taken the notes and read it. So anyway, I think your concern is really appreciated, because you have a big concern on the notes. Anyway, it's okay. Right. So I think now you got my point, and you now realize what you mean by hedging, and the arbitrage is also I explained. And now I can go to the notes. There's another thing I need to tell you: the speculation. The speculate. What do you mean by speculate? Speculate is you think that you have a view on something, stick to that view, and you just try to get some abnormal profit from that. That is what you call speculation. For example, if you have $100,000 with you today, now you keep it. You don't sell it. You keep it till the price goes to a certain amount. That is your view. Now you have a view that the price might go up to 290 in 1 week. That is your view, right? On that view, you keep the dollars with you. Now, if 1 week's time, if the dollar rate goes to 290, you would be in a position to sell that dollars. You might have purchased it for 200 rupees. And for each dollar, you will have a profit of 90 rupees. And if it's 100,000 rupees, it is 90 into 100,000. So that is 90 lakhs or 9 million. You might get a profit of 9 million for that. You see the point? So that motive comes through your view of on dollar rate. And that is what you call speculation. But the issue here is, if the dollar rate does not go up to 290, and it might have come down in time to come with the free flow of dollars or whatever, it might come down. So it might come down to 260 or 250 sometimes. Then he would not be in a position to get his profit as it is. Or sometimes, if he has purchased it for 200, if it has gone beyond 200, say 198, then he would have a loss. That is the issue. So speculation is that you just rely on a certain view and you do a certain activity. So the activity is to keep that dollars with you. So that is the activity. So that activity is called speculation, right? So I think now I have just explained you the three things. The first thing is the hedging. The second thing is arbitrage, and the other one is speculation. Now arbitrage is another thing where you can get a very good profit, but I don't think that's not very risky. It's, without any risk you can do that, but provided you can do simultaneously the sale and purchase, but in two markets. That is the issue. So if you can do that, you will be getting arbitrage profits, right? Anyway, now those are the things which the people, the parties do with derivatives. But derivatives are really meant for hedging, right? Now I will go to derivatives now. Right. Can you see the slide on the board? Can you see the slide on the board? Financial derivatives. Yes.
No, sir.
Can you see the slide on the board?
No, sir.
Just tell me, can you see the slide on the board?
No, sir.
Oh, you don't see. Right. Now can you see?
Yes, sir.
All right. Okay.
Yes.
Right. Right. Now we can start with the financial derivatives. Just an overview, right? So, but I will just put it into a more comprehensive thing at a later stage, and I will give some exercises also on this, and I think you might get a good idea about these things after completing the exercises and all. Anyway, right. Now in the introduction, derivative is a financial instrument whose value is derived from the price of a more basic asset called underlying. So every derivative you have an underlying, something called underlying. So that derivative's value is derived from the price of that underlying. Sometimes this underlying may not necessarily be a tradable product. Now I can just give you the examples of these underlying assets. Those are sometimes shares, commodities, or currencies, etc. Now, if you take the forward exchange contract as a derivative, their underlying is the currency. The price of the currency would be the underlying in that forward exchange contract. Right. Then anything which may have to a certain degree an unpredictable effect on any business activity can be considered as an underlying of a certain derivative. Now you can see the nature of an underlying. So that underlying is say that underlines some type of feature may have a very volatile behavior. So such volatile behaviored things can be taken as an underlying. Now the weather is a type of an underlying. Price of a commodity can be an underlying. Price of a share can be an underlying. Price of a currency can be an underlying. So that is how the underlying is defined. Right. Now then we can just look into the aspects of usage of derivatives. Usage in the sense how these derivatives are used. Basically, the derivatives are used by the banks and other financial institutions. Even some sophisticated type of investors also use derivatives because they know the purpose of derivatives or the use of derivatives in the hedging operations. Because for an investor, hedging is a very helpful mechanism to mitigate the potential losses from their investments. So if they can mitigate the losses from their investments, they can derive a higher return with a nominal risk. And you can just see the banks and other financial institutions use derivatives as powerful instruments to generate profits. Now, what do you mean by generate profits? So they can even generate profits. Not only that, the basic idea of a derivative is to hedging of risk. Corporates use derivatives as risk management instruments. Corporates means institution. Now for investments, there are two types of investors. One type is called individual investors, just like people like you and me are individual investors. And there are institutional investors. The corporate bodies, the banks, the finance companies, all are taken into the category of institutional investors. Basically, the institutional investors use derivatives as risk management instruments. Even individuals also can use that. There's no restriction for individuals to use derivatives. But the corporates, they frequently use derivatives for their risk management purposes. Right. Then we will see the types of derivatives we might come across in our investment operations, in our market operations, what type of derivatives are normally in operation. So the first type of derivative, we call them forwards. Now I just started my discussion with the explanation of forward exchange contracts. That is coming under forwards. That is a derivative. The category of the derivative is forwards. There's another type, we call them futures. Another, that is swaps and options. These are the 4 different types of derivatives in the used in the markets. Now, if you go into the global derivative market, it is now in very highly developed stage. I think you all will realize the usage, the purpose of derivative operations in the market. It is highly recommended for hedging. But some interested parties, they use derivatives for their ulterior profit motives. They might get very, very large profits through the derivatives. And that is what you call the speculations. So that's not a good thing for, if you look at the in terms of regulations or in terms of financial regulations, those have been restricted. Right. Now we will see the mechanism of the operation of derivatives and how it is being applied as a hedging instrument, how we can apply it to get some speculative profits or whatever. So there are different ways of doing it. And for an investor, this is very, very important. Right, now we go into forwards first. Though the heading is given as forwards and futures, we will discuss about forwards at the beginning. Right, now look at it. Forwards. It is a contract between 2 parties agreeing that at certain time in the future, one party will deliver a pre-agreed quantity of some underlying asset and the other party will pay a pre-agreed amount of money for it. This amount of money is called the forward price. When agreed, the 2 parties are legally bound by its conditions. Now, the conditions would be the time of delivery, underlying quantity, and the forward price. These are the conditions on which the 2 parties agree. Right. Shall we go back to that? It is a contract between 2 parties agreeing that at certain time in the future, one party will deliver a pre-agreed quantity of some underlying asset and the other party will pay a pre-agreed amount of money for it. This amount of money is called the forward price. When agreed, the 2 parties are legally bound by its conditions. Now I will just take a forward exchange contract as an example. Now there, as my earlier example I told you, there would be a forward exchange contract agreed with the bank. Now I gave that right. I think we had an issue with power. Now it has been restored. Are you with me? Are you with me?
Yes,
Yes,
we
sir.
can hear you.
Yes.
Right. Okay. Right. There was a power failure, and the particular connection was lost, and then they have been able to connect it again. Right. I think we just talked about these things. That different types of derivatives. Those are forwards, futures, swaps, and options. And I started discussing about forwards. It is a contract between two parties agreeing that at certain time in the future, one party will deliver a pre-agreed quantity of some underlying asset, and the other party will pay a pre-agreed amount of money for it. This amount of money is called the forward price. When agreed, the two parties are legally bound by its conditions. The conditions would be the time of delivery, the underlying quantity, and the forward price. Now, as I discussed earlier, I just gave an example of a forward exchange contract where to buy $100,000 by a customer from a bank, and for that he entered into a forward exchange contract with the bank. And for the bank, it's a selling contract, and for the customer, it's a purchasing contract. But normally, the forward exchange contracts normally given as per the bank's activity. So we call it a selling contract, because in a bank's point of view, we look at it, then we name the contract. Now, as my example, the contract is called a selling contract, forward selling contract. Now, for the forward selling contract, the time of delivery, say, for our example, it is 3 months. Underlying quantity is $100,000. The price would be, as I told you earlier, if I have just assumed that today's exchange rate is 275, and the forward price would be 285. So the forward price is 285 for that. So now I think you got my point, and you have just taken it as a forward exchange contract, and it's a type of a forward derivative. And for that, the time of delivery is in 3 months. Underlying quantity is $100,000, and forward price is 275. So that is how the forward exchange contract is explained. Now,
So, 275 or 280?
275 is the today's price, but
Right.
but the particular agreed price or the forward price is 285.
Ah,
285. Yes. Then the premium added is 10 rupees. Premium, we call it the forward premium. Forward premium is 10 rupees. So that is how it is been explained. I think if you have done this trade finance for the banking examination, you would have gone through these things, the forward exchange contracts. And anyway, the forward exchange contract is a type of a forward contract. For forward, it's a derivative, the nature of forward. Right. I think these things are now understood, I think, and the conditions are clear. Then on the date of delivery or time of delivery, what would happen? The party will go to the bank and purchase dollars at 285 per dollar, and he has to pay 285 into 100,000. So that is the price he has to pay. Right. So anyway, so that is what you call the forward exchange contract. Now, forward exchange contract is a type of derivative in the category of forwards. Forwards. And there's another.
So what are the standard features of forward contracts?
Fun.
Like standard features of forward contracts?
Wait. I will tell you. I will tell you. Now, still I have not gone into the futures yet, but I just talk on forwards. forwards, right? So I will just show you. Right. Now you have derivatives. Now in the form of derivatives, these are the types of derivatives. Forwards, futures, swaps, and options. Now these are the types of derivatives. Now basically there are four types of derivatives. Forwards, futures, swaps, options. Now still we are discussing about this type of derivatives, and under this you have forward exchange contracts. That is what we have now discussed. Forward exchange contracts. That is only one type of a forward derivative. Now I can just go into another one. Forward sales agreement. Forward sales agreement. That's another type of a derivative. Or sometimes we have forward purchase agreement. It is not with regard to foreign exchange. Now in the commodity markets, you have these forward sales agreements and forward purchase agreements. Now for example, say if you are a farmer engaged in paddy farming, when the harvest comes, you will have to sell it. But when the harvesting season comes, there will be a high supply of paddy. Then there will be a price drop. Then the farmers, what they do is, they just deal with some commodity exchange and go for a forward sale agreement. Forward sale agreement with that commodity exchange. I can give an example.
So, for this example, the underlying asset would be paddy, is it?
Paddy, yes. So then what they do is, they go and they just enter into an agreement with the either paddy marketing board or commodity exchange. Then what they say is, they might say they would sell paddy on a certain date, say another 3 months time. On certain date, another 3 months time, the forward price of paddy would be, say, 100 rupees per kilo. 100 rupees per kilo. And he would agree the amount of sale also. Say he might say 1,000 kilograms. 1,000 kilograms of paddy at 100 rupees per kilo on 3 months, after 3 months, or after 3 months time, or he can give a date. So that is what you call forward sales agreement for paddy. Then the time of delivery would be 3 months. Forward price would be 100 rupees per kilo. Then quantity would be 1000 kilograms. Now see the point. So that is how it is going. So that is another type of a forward derivative. We call it a forward sales agreement. So if it is a purchase agreement, we call it a forward purchase agreement. Forward purchase agreement of paddy, forward sale agreement of paddy, or sometimes some other commodity also you can do that way. Right? Then there's another thing called forward rate agreement. Forward rate agreement. Forward rate agreement. Now, what is the? Now, I am just giving you the basic applications of these things, because what you need is to have an idea about these derivatives. Now, I have just given you 3 examples of forward type of derivatives. First example I have given was forward exchange contract. The second example I have given was forward sales agreement. The third example I have given was forward rate agreement. What is the meaning of forward rate agreement? It's an agreement to, that is what you call FRA. Yes, FRA. Now FRA is an agreement to borrow or lend a certain amount of money at a certain rate. So that is the concept. But there can be several mechanisms for that. So I'm just giving you that particular understanding. And that is what you call a forward rate agreement. Right, anyway. Now those are forwards.
So all these agreement, all these type of products are available in Sri Lankan market?
No, Sri Lankan market. Yeah. No, Sri Lankan market actually this forward rate, forward exchange contracts are available. Forward sales agreements, forward purchase agreements are available, but not these forward rate agreements. Forward rate agreements are not in Sri Lanka for the time being. But in Sri Lanka, there have been, comprehensive type of SOPs are there. So in the SOPs, these forward rate agreements are in operation in certain instances. That is how the forward rate agreements are in operation in Sri Lanka. But just as forward rate agreements alone will not be operating in Sri Lanka alone. But in a SOP agreement, these agreements are in total it could be applicable. That is the way it is been applicable in Sri Lanka. Right. We will when we talk in terms of SOPs, we will talk on that. Right. We will discuss about SOPs later. So at that time, I will just discuss about these forward rate agreements and how can it be tackled with SOPs. And these are the generally accepted forwards in the world. Right. Then I will go to the next type of derivative, that is the futures contract. Right. Now it is very much easy for us to talk in terms of futures when you know the concept of forwards. I think now you are okay with the concept of forwards, is it? Now the applicability of forwards is this. Forwards is a type of a derivative where you can have different types of forwards. As I told you now, I have given you 3 examples of forwards. The number 1 is the forward exchange contract. The second one is the forward sales agreement, which I told you. The third one is forward rate agreement, that is FRA. Now we will go to the next level of derivative. That is what you call futures. The next level of derivative is futures. Now, when you say futures, now I will go to the definition. These are standardized forwards which are traded on exchanges. All futures positions are marked to market at the end of every working day. Now, I think this is a rather sophisticated type of a financial instrument, but the concept is same as forwards. Now, forwards, you have a forward price, you have a quantity, you have a time of delivery. But for a futures contract, even though it behaves similarly with the forwards contract or forward contract, there's a specific nature of futures contract. What is specific here? It can only be traded on exchanges, in an exchange. What do you mean by exchange? I think there are world famous exchanges. Chicago Mercantile Exchange, Chicago Board of Trade, New York Mercantile Exchange. There are several exchanges. Now in Sri Lanka, we have Colombo Stock Exchange, but the forwards are not, or futures are not being exchanged there, not being traded there. But that is also an exchange, right? I think you know what is an exchange. I will just take you into a certain website of exchanges, right? Then I will do that in this session today. Next part of the session, I will do that. So these are standardized forwards which are traded on exchanges. Now, what do you mean by standardized? The meaning is when you talk with regard to a futures contract, it has a standard form. So in other words, the standard, what is the standard? The time of delivery would be standard. Quantity would be standard. The price can be changed. That is what you mean by a futures contract. Now you got my point. It behaves same as a forwards contract, but it can only be traded in an exchange. But forwards, normal forwards can be traded anywhere. So here, there's another concept we need to discuss. Now that concept is called the forwards you can do as over-the-counter contracts. Over-the-counter contracts. OTC we call them. Over-the-counter contracts. Now when you say over-the-counter, if you have two parties, one party is selling, the other party is buying. So if that is the case, a forward contract can be executed. Such contracts are called over-the-counter contracts. There are two counterparties. Now, when you have two counterparties and two counterparties agreed upon, then the forward contract can be executed. Such contracts are called over-the-counter contracts. OTC. That is the way it can be given in shortened form. OTC, over-the-counter contracts. Right? Now, futures contracts cannot be done over the counter. It can only be done through an exchange. Therefore, such contracts are known as exchange traded contracts. Exchange traded contracts. ETC. Exchange traded contracts. So I will put it on the board. Now the futures contract can only be exchange traded. Exchange traded, right? But forwards normally over the counter. Over the counter. Or in other words, we call it OTC. Now, when you talk in terms of futures, the futures in principle behave as a forward contract, but it has some specific nature or standardized nature. It can only be traded on an exchange, and the quantity is a standard quantity. The time of delivery is also standard. So then when we talk in terms of futures, those futures are available for trade only in trade exchanges. Now, one of such exchanges, you can say, that is, as I told you, the Chicago Mercantile Exchange. That is one. Chicago Board of Trade. Forwards also can be traded. It can be traded, but not in exchanges normally. It is a over-the-counter type of a thing. Over-the-counter type of a thing. Right. So anyway, since it is over-the-counter, the forward contracts, it can be done everywhere, anywhere, since it is over-the-counter. But futures contracts can only be done through an exchange. So that is the main difference of futures with forwards. And the other difference is futures contracts have a standardized quantity and time. Standardized. Now, the names are given normally. In Chicago Mercantile Exchange, you have oil futures.
Sir.
Yeah. Yes.
Sir.
Yes.
Sir, we lost
Yeah.
power here.
Okay, what is the question? Okay.
The main differences.
Yeah. Now, when you say forwards, the forward contracts are normally the over-the-counter contracts. So when you have two counterparties and if they agree upon, then they can have a forward contract. Such contracts are called over-the-counter. So they are the underlying quantity, the time of delivery, and the price can be agreed on by both parties. Such contracts are called over-the-counter contracts. Basically, the forward contracts are over-the-counter. But when you go into futures, futures will have the same mechanism or same concept, but they are specific. Why we call them specific? Because the time of delivery is a standardized time. The quantity is also a standardized amount. And futures contracts can only be traded on an exchange, in an exchange only. So that is the main difference of a futures contract with the forward contract. Now, when you talk in terms of futures, different names are given for those futures. We call them sometimes oil futures, stock index futures, then we call gold futures. Likewise, there are several names given for futures. Right? So I think you all can have that idea about futures. Now I will go again to the presentation. Now the futures contracts will have so many other formalities. Why do I say formalities? Because since it is traded in an exchange, the exchange can declare or can impose several conditions on these futures contracts. And as per those conditions, every day, all futures positions are marked to market. The meaning is there would be a value for each futures position at the end of the day. I will just show you how it is being done. Now I have taken an example, a 3 month futures contract to purchase 100,000 barrels of crude oil. Right. So this is what I have taken as the example. Right. So such contracts are called oil futures contracts. Basically, this type of contracts are done in Chicago Mercantile Exchange. Chicago Mercantile. I will just take you through the website of Chicago Mercantile Exchange at a later stage today. Now I will just give the background, and afterwards I will just take you through the Chicago Mercantile Exchange website. Right. Now just look at it. Now the 3 months means it's a standard, and 100,000 barrels is another standard of oil futures. Everywhere in the world, if there's an oil futures, you talk in terms of 100,000 barrels of crude oil, and the time of delivery would be 3 months from today. So that is what it means as a oil futures. Price can be changed. Right. Now the example is you are going to have a 3 months futures contract to purchase 100,000 barrels of crude oil at $60 per barrel. I think now you heard that these days the oil prices have gone up, sharply gone up, and I think it went to up to $130 per barrel. But now it has come down to $100. That is what I heard about oil these days. Right. Now I will show you what is really being done on these marking to market scenario for the futures contracts. Now the time is given as 0, that is today, and number one is first day, second day, third day. That way it goes. Now this futures price basically the first day of purchase, that is time number 0, is today, right? It was purchased at $60 per barrel. Now when you talk in terms of a futures contract, there would be a buyer and a seller. As per the exchange's conditions, a buyer or a seller of a forward futures contract should open an account with the exchange. That account is known as the margin account. That account is known as the margin account. I think you got my point. You can't deal with futures contracts individually. It is compulsory for you to go to an exchange to deal with a futures contract. Either you buy or you sell. Right? You can engage with a futures contract to buy certain things, and you can engage with an exchange to sell a futures contract. Both ways you can do. Whatever the way you go for the futures contract, either to buy or either to sell, buy or sell, you need to open a margin account in the exchange. But for forwards contracts, that type of conditions are not there. You can freely do that. If you have two persons, two counterparties, you would be in a position to execute a forward contract. But a futures contract, to execute a futures contract, you need to engage with the exchange. Not only that, either party, I mean, a buyer or a seller, both will have to open a margin account with the exchange. Now I will just tell you what is the meaning of this margin account, or what is the purpose of this margin account. Right? Now just look at it. Now the margin account on the day of purchase, it was purchased at $60 per barrel. That is taken as the price. And the buyer's account, there's no entry on the first day. No entry on the first day with the margin account, but on the second day, or on the first day, sorry. On the first day means not the current day, next day, tomorrow. What happened to the price of the futures? It has gone up to 61. Now what has happened to the buyer's account? What has happened to the seller's account? Now just look at it this way. If I am a buyer, I have agreed to buy it for $60. And now the price has gone up to $61. Now are you the buyer? I'm talking about the buyer. Would the buyer now is in a favorable position or adverse position? Because he has already agreed to buy that at $60 per barrel. Whereas the price, the market price of the the barrel of oil would have gone, it has gone up to $61. In the buyer's perspective, would it be an advantage or disadvantage? I'm asking that question from you. What do you say? The price has now gone up to $61. In the buyer's point of view, would it be an advantage or disadvantage to the buyer?
To the buyer, it's a disadvantage. For the buyer, it's a disadvantage.
You say it is a disadvantage.
Because the price is gone up. If he's buying,
no, even though the price
on the next day.
No, even though the price has, yes, even though the price has gone up, he has already entered into a contract to buy that dollars at 60.
Buyer is in a favorable.
Yeah, buyer will have an advantage.
Then it's a favorable. Yes, advantage.
Yeah.
Right.
Yeah, it's an advantage to the buyer. Yes, it is an advantage to the buyer. So that is why we have credit buyer's account with 1 per barrel. That is why we credit his account, margin account, because he is at a profit. Now, how it would come? He has already entered into the contract to buy a barrel of oil at $60 per barrel. Now, in the process, next day, the price of a barrel of oil has gone up to 61. Even though now it has gone up to 61, the buyer can buy it at 60. So therefore, he is with an advantage now. Therefore, the advantage, the amount of advantage is $1 per barrel. But this particular futures contract has how many barrels? 100,000 barrels. So therefore, his account would be created with $100,000. His margin account, right? Now you just look at the seller's account. What would happen to the seller's account now? Seller has agreed to sell that futures at $60. On the next day, the price of a barrel has gone up to 61. Now, what is the seller's position now? Seller would be at the disadvantage, because the price has gone up. But if he has already sold it at 60, then he need to bear the loss, because if he has not sold that on that day, he would have sold it today at 61, whereas he sold it for 60. Therefore, he would have a disadvantage. So that amount is -1. Have you got my point now? Are you okay with that?
Yes, sir.
Right. So then seller's account will be debited with $100,000. Right. Now the next day, day after tomorrow, the futures price has gone down to 59. 59. Now just look at it. Now from here onwards, we just look at the previous day's price, not the original price, right? Previous day's price. If you compare this price with the previous day's price, the buyer would be at a disadvantage. That is -2, because earlier day it was $61, but this day it has come down to $59. Then it's a disadvantage. $2 per barrel. So then his buyer's account will be debited with $200,000. That is how it goes. Seller's account, the seller would be at an advantage, and his account will be created by 200,000. That is how it goes. Then if you take another day, I think this has already been prepared, not taking into consideration the days, but the months, right? Since it is a 3 months contract. Now, first month, second month, and third month. That is how it goes, right? So therefore, you can just look at it that way. In the first month, buyer's account would be created by $100,000. Seller's account would be debited by $100,000. On the second month, buyer's account would be debited by $200,000. Seller's account would be credited by $200,000. Next month, third month, it would be $58 further reduced. The price is further reduced, and if you compare it with the previous month, it is -1 for the buyer. Then the buyer's account would be debited by $100,000. Seller's account would be credited by $100,000. Now, if you take the whole period, you have to net off. Now, what will happen to the buyer? Buyer would be at a disadvantage, and his account would have a 200,000 debit altogether. Seller will have a 200,000 credit. Now you got my point. That is how the margin accounts are maintained with regard to the futures contracts. Any question? Any question on that?
So similar to
This
FRAs, futures also not in Sri Lankan market, no?
And
Futures also in Sri Lankan market you can't see.
no, we can't see futures in Sri Lankan market. But only thing is now, when you deal with certain investments, the Sri Lankan investments, but those investments are attached with some futures contracts sometimes. Then we have to analyze those futures prices also. That is how the need arises. Otherwise, you might think that these things are not necessary, because since we are not seeing these things in the Sri Lankan markets. But it could not be the case, because even though we directly don't do these things, but there can be several investments which are related or which are connected with these international transactions.
So
therefore,
what would be
we need to have
examples?
knowledge. Yeah. Basically, the even this petroleum corporation also has to deal with this type of things. The petroleum corporation. They now, I think nowadays, I think you all know now what are the difficulties faced by the customers, the people in the country. You can see, but the Ceylon Petroleum Corporation has not done their part on the oil purchases or whatever. That's what happened to Sri Lanka. If they have gone through the markets, if they have gone through the futures markets, the exchanges, and just found out these things, they would have done it in a better way. They could have done it in a better way. Then the people would not have to face so much of difficulties. Right. Forwards and futures are designed to reduce risk related to the uncertainty of future market prices for both sellers and buyers of underlying assets. Now, what do you mean by underlying assets? Now, in the futures contracts, what are the underlying assets? The oil. Oil would be the underlying asset there. Now, there's a terminology used in these futures transactions. Not only futures, in other transactions also. When a person buying a futures contract, we call it loan futures. We call it loan futures. When a person selling a futures contract, we call it a short futures. Loan futures and short futures.
So then basically when loan future is get into a loan future mean buyer would think that in the near future the price will go up.
Yeah, that's correct. Yes, because buyer is with that opinion, that attitude. Since it is going up, he has now purchased at a particular price because he thinks that it is advantageous for him.
Okay. For that, what would be he's going to pay to other party? Is it a PO? What for that agreement?
Yeah. Now, futures contracts are not any fee based. There's no fee to be paid. But only thing is, you have to keep a margin amount in your account. That's all. There's no fee charged. There's no fee charged, but as per the price of the futures, there will be debit or a credit to your account. But you need to have an initial margin also. These initial margins would have a payment of interest. So therefore, there's no commission, no any fee paid on the future. Only fee he has to pay is the margin requirement. The margin requirement. I will just explain it on the board, right? So what is really happening? Say for example, now I can take example of one buyer and one seller of futures contract. Now when he goes to loan futures, the exchange would ask him to open a margin account, and according to his contract, according to the futures contracts he would purchase, there will be a margin requirement. What do you mean by that? The margin requirement is the amount of dollars he has to deposit in the margin account. So that is the credit balance, right? Now, I'm just giving you a hypothetical margin amount, say for this particular one, because this is a $100,000 operation. Sorry, 100,000 barrel operation. Now, 100,000 barrel means $60,000, $60 per barrel. So the whole contract would be $60,000. 16 to 100,000, not 60,000, 60 lakhs. Or in other words, it is $6 million. $6 million contract. For a $6 million contract, what is the margin? Say, now we can assume the margin is, since it is 6 million, the particular value is 6 million. Because why we call it that way? Because the loan futures person would buy it at $60 per barrel, and the quantity would be 100,000 barrels. 100,000 into 60 would be 60 lakhs. 60 lakhs means $6 million. Now, when you say $6 million, now if you take that is 60 lakhs, no, 60 lakhs. We for the simplicity we can put it as 60 lakhs, right? If it is 60 lakhs, 10% of which would be 6 lakhs. 6 lakhs to be deposited as the margin. So I'm just giving you a hypothetical scenario. So the person has to, the person who buys futures will have to deposit $600,000 in his margin account. Okay, that is the margin amount. Now, the other party also should have to do that. The party who is selling that also should deposit $600,000 into his margin account. Then the margin balance would be 600,000. Sorry, yeah, 600,000 or 6 lakhs. And there's another thing called maintenance margin. Maintenance margin. Now, what do you mean by maintenance margin? The exchange will tell these buyers and sellers their maintenance margin is so much. Now, hypothetically, we can take it as a can you see the screen? Again, the power failure came up. Hello?
Can hear you, sir.
Right. Now you can see the slide on the screen.
Yes, we can see.
Right. Right now we are at this point, and I told you long and short futures and the requirements, margin requirements. Now, as I told you, for any person or institution, any counterparty who tries to buy futures or tries to sell futures will have to open a margin account with the exchange and have a deposit, and we call it initial margin. Now in our example, it's an oil futures example at a price of $60 per barrel, and it involves 100,000 barrels. Therefore, the transaction is for 60 lakhs transaction or $6 million transaction. So the buyer of these futures will have to have a 10% of the transaction amount as the margin. That is 600,000 or 6 lakhs. That amount has to be deposited in his margin account by the buyer. In the same manner, the seller also will have to do that. Then now in the exchange, the buyer's account have a credit balance of 100,000, and seller's account also will have a credit balance of 100,000. Right now, that is the standing or starting position. At the end of the first month, what will happen? As I told you earlier, at the end of the first month, the buyer's account will be created with $100,000. Seller's account will be debited with $100,000. So, as a result, the buyer's account will have a total credit of $700,000. Seller's account will have a total credit of $500,000. If you, when the second month comes, the buyer's account will be debited by $200,000, and seller's account will be credited by $200,000. So likewise, it happens. Then at a certain point of time, and there's another, as I told you earlier, now I have told you, one margin is called initial margin. The other one is called maintenance margin. Basically, the maintenance margin is lower than the initial margin. Maintenance margin is same for this particular thing. Maintenance margin we put as 200,000. So, what is the meaning of maintenance margin? The buyer and the seller has to maintain in the margin account a minimum balance of 200,000. If that balance goes beyond that, the buyer or the seller has to, whatever the case may be, reimburse that or maintain that margin throughout. If any day the margin would not be maintained, the initial margin, then there will be a requirement to fill up the initial margin. That is the issue. I don't know whether you got my point. This margin requirement is a very tricky situation. Now, when the margin, now I told you two types of margins. One type is called the initial margin. That is basically a higher amount. And there's another thing called maintenance margin. Maintenance margin. Maintenance margin is basically lower than the initial margin. The requirement is the buyer and the seller will have to maintain a minimum balance of the maintenance margin throughout the transaction. If one day, if the party, either seller or the buyer, whatever, are not in a position to maintain that $200,000 minimum balance, then they would have to reimburse the account up to the initial margin. So that is, you have to put 600,000. Or in other words, now if you have gone beyond 200,000, that means 100,000. So from 100,000 to 600,000, you have to fill back or the reimburse. That is another 500,000 you have to reimburse. So that is it's a dangerous type of a thing where these buyers or sellers of futures transactions would have to honor the margin requirements. Would have to honor the margin requirements. Are you clear with that concept? Are you clear with that concept?
So here, there's no initial investment cost for this, right?
No, it is not an investment cost, but only thing is that initial margin has to be placed. That is a deposit. That is a deposit, and that deposit would be paid the interest also. You got my point. But you can't say there's no cost, because the thing is, if you have to put 600,000 into your account at the beginning, there's a cost involved, no? Whatever it is. Now, there's no straightforward type of a cost, but there's a, indirect cost could be there, no? But there's no direct cost is not there.
At what price subsequent sales are happen?
No,
I mean, you if I purchase at 60.
Yeah. No, it is not. No, it is not the case. The sales are happening. Only thing is the price changes. Now, for a foreign exchange, there are 100,000s of transactions are taking place, every day, right? So therefore, this particular one I am talking about, now they are not going to sell low by anything. What they do is they have to mark to market every day. That is what happens. This margin account transactions are taking place as a result of marking to market. You know what I mean, sir? Yeah.
I mean, sir, if I want to sell my futures contract,
yeah,
how it happens?
No, this is not the selling or buying of a futures contract, right? Now that sale or purchase you have already done, right? But this is the maintenance. But so right, I think you just get confused. This is what I need to tell you, right? Now I have taken two counterparties. One counterparty is the buyer's party. The other counterparty is the seller. One counterparty is the buyer. The other counterparty is the seller. Now buyer has to deposit $600,000 into his margin account. Seller also has to deposit $600,000 into his margin account. Now, they are not going to sell low by anything. They just did that. Now already they have done. But every month end, the exchange will go through the
Sir,
future price. Yes, yes. What is your question?
So
Yes.
that is understood. I mean,
no.
already I have a contract, so I want to
Yeah,
sell it.
yeah, yeah. No, if
So
you want to
then
sell it, if you want to sell it, right? If you want to sell it, there will be another process, right? This is not the process for selling, right? This is the market to market process,
yeah, that understood.
right? Okay. Now, if one person to want to sell it, then he will talk to the exchange and try to do the selling. So we call it winding
Yeah.
up. Winding
Yeah.
up. We call it winding up, right?
Then
That can
at
be done.
what?
That can be done at the time. If the
price, then at what price I am selling?
now what they can do is they can just sell at the current market price. They can sell. They won't. But there can be a penalty for that. There can be a winding up. Now if there's a winding up operation, there will be a penalty because their contract is to keep it for 3 months. No, it's a 3-month contract. But if in between, if you do something, what will happen is you will have to pay a penalty for that. So that means you are not going to honor the contract. No, that is what it means.
Yeah, you mean, sir, in between we can't trade it, ne?
Yeah, that's the thing. Yeah, if you want to trade, you can do that, but there will be a penalty for that because you are going to dishonor the contract. No, in that case. Now, this buyers and sellers contract could be for a period of 3 months. No, in between, if you want to sell or buy, that means you are going against the contract. Then you have to face the consequences if you do that.
If I am holding until maturity, sir, should I deliver the underlying to the buyer? Or?
Yeah, this underlying delivery is a different thing. This is only a case of transaction, right? This underlying delivery is a separate case. That's what I think your question is very valid, but this delivery of underlying is another part of it. These people are not really responsible for that. That responsibility goes to the exchange, not
Sir,
for these people. Yeah.
now after 3 months, is there an exchange of goods here?
Yeah, there are, sir. There are
100
exchange of goods. Yeah, it's there. It's there.
After 3 months, there will be exchange of goods. The buyer is buying and seller is saying selling 100,000 barrels.
Yeah, it is there.
Right.
Now, this accounting is only for this market to market process. This accounting is for that. So therefore, I think you should not confuse the selling and purchasing process with this. This is what you call the market to market process. The delivery of goods and all sort of things are taking place in a separate way. But as you say, at the end of the 3rd month, this should happen that way, as it is. The delivery will be done.
The instrument cannot be traded, right? So you mean?
You can't trade the instrument. Yes, you can't trade the instrument.
Okay.
If you trade the instrument, there's a way. I think I can't say you can't, but there's a way of doing it because you are not going to honor the contract if you are going to trade it in between. So then you have to pay the penalties and all that. That is the issue. Right. Okay. I think this marking to market process is now understood, is it? Now I will later I will just give you some examples and exercises. Then you might really get it understood in a proper way. Now I will just give you a small break, and we will meet by 3:50. Now with regard to the margins, I am just describing something now. Now, the marking to market process there you have very important points to know. The first one is the initial margin. Now, second one is the maintenance margin. Now, the meaning of initial margin is at the time of engaging with the trade or contract. Buyer and seller both will have to deposit an amount recommended by the exchange in margin account. Right? Buyer and seller both will have to deposit an amount recommended by the exchange in margin account. So that is what you call the initial margin. Then the second one, that is the maintenance margin. The minimum balance that the buyer and seller maintain in the margin account. The minimum balance that the buyer and seller maintained in the margin account. That is what you call the maintenance margin. And there's another requirement. If the counterparty has a margin account balance, as the margin account balance goes beyond the minimum balance, then the reimbursement to be done. That reimbursement is not with the maintenance margin. You have to reimburse the amount, the gap between the present balance and the initial margin. If I put an example, say, in my example, the initial margin is say $600,000. Maintenance margin is $200,000. Now say the balance of this one of say buyer's account has gone to 100,000. USD. Overnight, the balance has gone down to 100,000. So then, what is the amount to be reimbursed by the person here? What is the amount to be reimbursed? If a particular buyer or seller's account balance has gone down to 100,000, now it is lower than the maintenance margin. So then, invariably there will be regulatory action. Would be taken by the exchange. So now my question is, what is the amount to be reimbursed by this account holder? Can you put it in your messages? Yes.
So required balance is 200,000, but the
Yeah.
current balance is 100,000.
Yeah. Then what is the reimburse? How much he has to reimburse then?
100,000.
That's the thing. Now I think I need to get that answer, but it is not the answer. Because since the value has gone beyond maintenance margin amount, he has to reimburse up to the level of initial margin. That is the answer. So therefore, the person will have to put another 500,000 to come into the level of initial margin. That is the answer. You got my point?
Yeah, sir. Yeah, that it's like this now. Initial margin is 600,000.
Yeah.
Then
now you have to maintain that, but there's a particular concession. You can go up, go down to 200,000. 200,000 is the maintenance margin, because if you maintain that margin, there won't be any reimbursement. If you maintain that, so that in other words, 200,000 is the minimum balance you maintain in the account. If that balance goes beyond that, goes below that, then the reimbursement has to be done not to the reimbursing the maintenance margin, but to the
Initial.
reimbursement of the initial margin. That is the case. That is the case. So therefore, buyer or seller should make it a point not to go beyond the maintenance margin, not to go below the maintenance margin. So that is what they need to look at. They look into that and they make it a point not to go below 200,000. If they go below 200,000, then there will be a drastic issue for them, because they need money for that. No? They need liquidity for that. So that is the issue. I think you got my point. Asanka? Okay. Are you okay with that?
sir, now is it similar to this margin trading one? Margin trading on shares?
Yeah, same thing. Yes. More or less same. There are some differences here, but
Okay.
the concept is the same. Yes, concept is the same. There are some differences, but the concept is the same. So I think the accounting is very much important for this one. Right, I think you got my point, because what I want to tell you is, even for investors, this is a very critical situation, because they need to have liquidity to do this. No, otherwise they will be in trouble. They will be in trouble.
Then who's going to monitor this maintenance margin? Like someone is going
Yeah,
to
monitor in the sense, this exchange will do that. Exchange will have, they have a clearing for them, so that they will really look at it. This is a very regulatory type of a thing, the exchanges are regulated, highly regulated.
Then sir, when it come to maintenance margin, how it depend? Like it's based on the value of the future.
Yeah, value of the future. Yes, basically, I have just given you a hypothetical scenario here. But if you go to a real situation,
Yes.
you will find those things are done at a certain principle. For each, there are different futures. No, for each future there's a given initial margin and a maintenance margin.
Okay.
Right. Now we will go to the next level. Now we have already covered two types of derivatives. One is forwards, the other one is futures. Now futures, actually there can be several futures. Now I told you I have taken an example from oil futures. There can be gold futures. There can be stock index futures. There can be interest rate futures, or all sort of futures would be there. Then you need to see how these futures behave in exchanges. Right. Then we go to another explanation on another type of derivative, that is a swap. Now just look at the explanation for a swap. It is a purchase and simultaneous forward sale, or vice versa. What do you mean by vice versa? It is a purchase and simultaneous forward sale, or it is a sale and simultaneous purchase of a financial instrument. So that is what you mean by a swap. If you put it in a diagrammatic way, purchase, first thing you purchase, and at the same time you sell the first same financial instrument. Purchasing the financial instrument today and selling the same financial instrument forward. That is what you mean by swap. Or in other words, there's another way of putting it: agreed exchange of future cash flows with the spot exchange of cash flows. Spot, you have exchange of cash flows, and we have another future cash flow exchanges. That is the second type of it. And if you go through some type of examples, you will really understand these things. Then we just look at another swap called FX swap, or foreign exchange swap. Simultaneous purchase and sale of a specified amount of currency for different maturities. So purchase and sale. First thing you do a purchase, then in a forward way it is a sale. Or first thing you do as a sale, and the forward would be a purchase. That way. And a specified amount of currency for different maturities. So those swaps are given different names. One is fixed date delivery, the other one option delivery, short swap, long swap, structured swap, and so on and so forth. Only thing is, now I am not going to explain all these things, but you need to have some idea about all these different type of things. But I don't think that these minute details are not that necessary, but I will just go through some examples, and those examples will give you a certain amount of understanding.
So what is divided swap?
One,
Divided SOP.
Divided.
Divided SOP.
Divided SOP. Yeah, maybe. Divided in the sense now sometimes parties can have their own way of explaining the SOP. Divided SOP, no, dividend SOP or something. I don't know. I have not
That's
really, I have not heard about it, but I don't think the particular one. Can you just explain the circumstances on which it comes?
So I also heard from somebody this divided SOP. It's like as per that, I am not clear on that, but as per the explanation, it seems like there could be two different parties, something like that, divided SOP.
Maybe, but anyway, I have not seen in normal general text or whatever. Anyway, I will look into that and tell you, because I also don't have that much of an understanding on divided. I have not heard about it earlier.
Okay.
But anyway, since you have told me that there's a thing like that, then I will just look at it and see what it is, and I will come back to you with explanations. Right, now this is about SOPs, and we will see the operation of SOPs before going into the options. Now these are the specific types of derivatives we might come across. FRAs. FRA is a forward rate agreement that we have already discussed. Then there's a thing called interest rate swaps, stock index futures, interest rate futures, commodity futures. Now I think you can see several futures transactions in different names. And interest rate swaps is another very important and very famous type of a thing. FRA is a forward rate agreement. So I'm just asking you, FRAs. Now tell me the category of derivative here. What is the category here? FRA. Now you have heard about now 4 types of derivatives: forwards, futures, swaps, and options. FRA is how are you going to put FRAs? To where you are going to put FRAs? Forwards. Yes, you can put it as forwards. Yes, correct. Then interest rate swaps. So I don't need to ask that question, because it is a swap, of course. Swap everywhere. All others are futures. So therefore, no need of a question here. Right. Now we will go through these specific types of derivatives. Now, I want to just tell you at this point, this derivative, the lesson of derivatives for you, for the investment and portfolio and investment management students. The detailed or very comprehensive things on derivatives would not be necessary. But what I see is you need to have a general understanding of derivatives, general understanding on mechanisms and operation of derivatives, and the main purpose of using derivatives, and all these things are necessary for you, but not the highly comprehensive and highly sophisticated things on derivatives. Therefore, I have just prepared my presentations on that basis. Otherwise, I would have to assign a 4-hour lesson for only one type of a derivative. But rather than doing that, I just want you to be a generalist on derivatives, because you can have a good idea about derivatives. You can have a good idea of how the derivatives be used. such type of things you need to understand. Right. That is why I have taken several things here, not only one thing. Just look at forward rate agreements. An FRA is a contract between the buyer and the seller, wherein the buyer commits to pay the seller the contract interest rate on the notional sum over the stipulated period. The notional sum is neither borrowed nor lent. Now, I don't know, when you go through this text, when you go through this statement, are you getting any idea? Since you are not getting an idea, I just explain it. FRA, that is forward rate agreement, is a contract between the buyer and the seller. Now, when I say buyer and seller, normally with regard to the funds, how do you name these people? Are we telling buyer or some other word? The buyer is the borrower, really. Seller is the lender. Lender or say creditor. Buyer is the borrower. So buyer and the, when I say, rather than telling it as buyer and the seller, we can say borrower and the lender. And borrower commits to pay the seller the contract interest rate on the notional sum. Now look at it. What do you mean by notional? Now, notional means you have a sum. In order to calculate the amount of interest, rather than exchanging it, say you say notional amount is so much, say 1 million rupees or $1 million notional sum. Interest rate is say 5%. Then the borrower has to pay 5% on $1 million. So what is 5% on $1 million? When you calculate, 5% of $1 million would be $50,000. $50,000 to be paid as interest during a stipulated period. So sometimes the FRAs are for 2 3 months or that. Now, why we call it a notional sum? It is not borrowed or lent. Just to say that it's a notional sum, because in order to get the interest calculated only, you have a notional sum. So that is how the forward rate agreement is explained. Right. Then interest rate swap. An interest rate swap is a bilateral agreement to exchange the sequence of interest payments of differing. Yeah.
Can you explain again the notional sum?
Yeah, notional. Yeah. So I can get an example, right? So there's an FRA, borrower and lender agreed on to. As per the agreement, the borrower has to pay in 3 months' time the rate, say 5%. The notional amount for this contract would be $1 million. Right? So that is the agreed amount, 5 million. Sorry, 5%. Now, if the interest is, now he would pay 5%, but say there will be another mechanism here. But in order to just give the idea of this notional sum, it is as you pay interest for 5% on 3 months' time. Now, in order to calculate the amount of interest you need to pay, a notional sum is introduced. That is what you mean by notional sum. So that doesn't mean that you are going to borrow that, but as if you put it that way. Anyway, I will just give you an example at a later stage, not now, because I want to go to the interest rate swap also. Afterwards, I will come to forward rate agreement, and then again, I will explain that. Now, for the moment, you just think like this. Now, this is only for the rate we are talking about. So then, when you just agree to borrow something from the other party, that party is called the lender. This is a borrower and lender between the agreement between borrower and lender. Borrower agrees to pay a certain rate of interest on 3 months' time. And when the day arises, the person will pay that amount of interest to the lender. Now when someone wants to pay interest, then he needs to get the amount of interest which he has to pay. No? In order to get that amount calculated, only the notional sum is agreed on. That is what you call the notional sum.
Sir, here what would be the underlying asset?
Underlying asset would be the amount, that notional amount, that is the value. It is the asset. The price of that asset, no, we are talking about, that's what. The price is the interest rate. Therefore, the asset would be the notional amount of that money, even though it is notional. Since it is underlying, even though it's a virtual one, it is underlying. I think I just told you that at the beginning, underlying can be an intangible thing. So therefore, the underlying thing is this.
Now here the underlying asset is not tangible.
Not tangible, yes.
All right.
Now then we go to the interest rate swap. An interest rate swap is a bilateral agreement to exchange a sequence of interest payments of differing characteristics based on a notional principal amount that is never exchanged. There also you get a notional amount. Why do we put it as a notional? Because you are not going to exchange that particular value. Only the interest amounts you are going to exchange. That is why we put it that way. Even in forward rate agreement also the same thing happens. We only just deal with the amount of rate, not the total amount. Right. Now just look at operation of an interest rate swap. Now, the bank is the principal institution in this interest rate swap operation. The bank will have to deal with two borrowers. And what the bank is doing is, bank will pay a floating rate of interest and receiving a fixed rate of interest. Right? Now just look at it. Bank, you see the bank in the middle, right? Then there are two borrowers, borrower A and borrower B. And there are two lenders also, lender A and lender B. Now, this borrower has a commitment with lender A, borrower B has a commitment with lender B. Now, the bank has two types of borrowers. What the bank does is, bank is having a floating interest rate flow, cash flow from the borrower B. And the borrower A will give the bank a fixed interest rate. Now, I just want to tell you the way it has to be done. Now, it is really happening for situations where a bank is having depositors and borrowers. Now, just to say that, right, we can just think about the present situation even. Now, you might have borrowers, and from those borrowers you are receiving interest. I don't know whether it's a floating interest or fixed interest. Now, if it is a fixed interest, now the bank is in trouble because now the market interest rates are going up. When you receive in fixed, then what will happen? Now, you have received fixed interest for a long time, but still you are receiving the same interest rates. Then you are in trouble because you have to get those funds at a higher rate of interest. Then the bank will have to face with interest rate risk. Therefore, bank will have to arrange this type of a swap. Now, what do you mean by floating? Floating means you have a certain market interest rate connected with that. Now, for example, if I say 3 months treasury rate plus 1% as a rate, that would become a floating rate because each and every day the 3 months treasury rate changes together with the market. So then you can have a floating rate. Now, if you are receiving the floating rate in an increasing interest rate scenario, you are okay with that. But when increasing interest rate scenario, if you are receiving a fixed rate, you would be in trouble. Alternatively, in a declining interest rate scenario, if you are receiving fixed rate, that would be advantageous. But if you are receiving floating rate interest, then when the market interest rates are going down, you will be in trouble. I don't know whether you got my point. This is a dilemma between fixed interest rates and floating interest rates. In a situation where the interest rates are going up, your interest payments, if your interest payments are fixed, you are okay when interest rates are going up. Right? When you are receiving fixed interest rates at that time, then it is at disadvantageous because you are not going to receive higher interest rates. Now, have you got my point? So this will really put the bank into a risky position. Therefore, bank should arrange a certain mechanism through an interest rate swap to deal with such situation. So I think you got my point. Now say for example, bank, there's a borrower A and borrower B. Borrower A for the bank. Now there are two things. Borrower B has an agreement with lender B, and borrower A has an agreement with lender A. Now this borrower A's agreement with lender A is a floating rate, because borrower A has to pay a floating rate to lender A. Borrower B has to pay a fixed rate to lender B. Now, this fixed rate scenario for a borrower is favorable in which scenario, in what type of interest rate scenario? Borrower is paying fixed rate. What is advantageous? In which circumstances it is advantageous to the borrower? Paying the fixed rate. Yes.
If the interest rate is going up.
Yeah. If the interest rates are going up, for a borrower, paying the fixed rate would be very advantageous, because his interest expenses will be fixed, even though the market interest expenses are going up. Conversely, the lender, if a lender has a fixed rate, what is his advantage? In what scenario the lender having a fixed rate be advantageous? When interest rates are going down, is it? When interest rates are going down, if a lender is receiving a fixed rate, that would be advantageous, is it?
Yes.
Right. Now that way you need to look at it. Right. Okay. Now the banks normally arrange certain type of derivatives or interest rate swaps to face with such situations. Now, for example, say bank is now borrowing. Borrowing in the sense, what do you mean by a borrowing for a bank? A depositors, basically. Depositors, right? Now you have a deposit base. You have, say, fixed rate deposits and floating rate loans. See, if you have that way, you have floating rate loans and fixed rate deposits. Now, it is good when interest rates are increasing. When interest rates are increasing, that arrangement is a good arrangement, because you have loans, so you have borrowers. You have borrowers, and those borrowers will pay you a floating rate. Interest rates are going up. You have a lending, or you have loans with floating rate. When interest rates are going up, you will be in an advantageous position. And at the same time, you need to maintain fixed rate deposits. Now, if you maintain fixed rate deposits, you are not going to pay higher amounts for those deposits. In that case, you are really making profits, because since the floating rate interests are, you are receiving this interest from your borrowers, and you will pay only fixed rate to the depositors. Only fixed rate to the depositors. Right? So then you are at an advantage. But if you have a the other way. Now, if you are paying fixed rate to the loans, that means your depositors you pay, your depositors you pay a floating rate, then what would happen? When the interest rates are going up, you have to pay a higher rate for your depositors. But if you are getting fixed rate for your loans, then you are not getting higher income for your loans. So that is also another issue for you. Now, if you have such type of issue, you can arrange an interest rate swap to get rid of that situation. Get rid of that situation. Right. In order to have a understanding about interest rate swap, I have just given an example, right? I will read it for you. 3 years swap initiated on 5th March 2022 between Microsoft and Intel. Two computer companies, Microsoft and Intel. Microsoft agrees to pay 5% per annum for a principal of $100 million. And in return, Intel agrees to pay Microsoft 6-month LIBOR rate. Now, when you quote the rates, there's a thing called LIBOR. I think nowadays the LIBOR has been really discarded. But anyway, it's a rate. It was a rate for a very long time. LIBOR means London Interbank Offer Rate. Now, for different terms, the LIBOR rate would be different. Now, say 6-month rate, 1 year rate, 1 month rate, likewise, there would be LIBOR rate. But that rate varies every day. So, therefore, now the date is given as 5th March. For each month, after each 6 months, 5th of that month will become the interest payment and receiving date. One party pays interest at 5%, that is a fixed payment. The other party will pay interest at LIBOR, 6-month LIBOR rate. 6-month LIBOR rate is a floating rate. Right? Now, in this particular case, the two parties are, one is Microsoft, the other party is Intel. The other party is Intel. Now, as per the illustration between Microsoft and Intel, Microsoft agrees to pay 5% per annum. Microsoft to pay 5% per annum, that is fixed. 5% fixed per annum. Fixed. To Intel, that is what it says. Microsoft agrees to pay 5% per annum for a principal of $100 million. And in return, Intel agrees to pay Microsoft 6-month LIBOR. So the Intel will pay back Microsoft 6 months LIBOR. This is floating. And this particular swap would start on, it has already been started on 5th March 2022. 5th March 2022. And this is the first cash flow. Sorry, this is not the first cash flow. This is the, this is the first date. Yeah. Then I can put you the, I can just show you the different dates on which the interest payments been exchanged. So next date would be 5/9/2022, right? Then 5/3/2023, 5/9/2023, 5/3/2024. 5/9/2024. And again 5/3/2025. So these will be the interest payments. I can say number one, sorry, this is number one, number two, number three, number four, number five, number six. Just look at it. Now these are the dates on which interest payment being exchanged. Now here, as per the illustration, Microsoft will pay a fixed rate to Intel. That is at 5%. But Intel will pay Microsoft 6 months LIBOR. 6 months LIBOR. So then, how would they, at the end of it, how would they get an advantage or disadvantage? Now you got my point? The way it is being handled? Yes. If you have any questions, ask me. Any questions? This is the demonstration, and I can just show you the interest cash flows. But in order to get that, you need to understand, or you need to see what are the LIBOR rates on these particular days. I can put the LIBOR rates because the other one, the 5% fixed rate, it doesn't matter because any day it would be 5%. But the payment of Intel, that amount of interest depends on the LIBOR rate. LIBOR rate would be changed every day. So then I will put the different dates and the respective or relevant LIBOR rate for each day. Right? I will put that. On the 5th of March 2022, the LIBOR rate was 4.2%. The LIBOR rate. Five months or 6 months LIBOR rate. 4.2, 8, 5.3.
Sir,
Yeah.
at the end of sixth term, according to the agreement, Microsoft will pay 100 million to Intel, is it?
Not 100 million. Only the interest flow they would pay. Not 100 million. Now Microsoft will have to pay 5% per annum at the rate of 5% per annum to Intel. So the first payment would go on 5th of September. 5th of September at the rate of 5%. So then 100 million into 5%, but this is for a period of 6 months, no? So therefore, they will pay 100 into 5% divided by 2 because it's a per annum rate, no? Therefore, they would pay, I will just do the calculation, 100 into 5% divided by 2. So that is 2.5 million. So Microsoft will pay 2.5 million. 2.5 million to Intel on the first day.
So, in order to get into agreement like this, they do they have to have actually do they have to have 100 million in their accounts, personal accounts? In
No,
both
nothing,
companies?
no.
Without
that is why we call it a notional amount. Yes.
Without having any
Yeah.
money, they will.
Yeah. No, it is the purpose of having a notional amount is to facilitate the calculation of interest. That's all. They just exchange the interest cash flows. That's all. Now I have just put the LIBOR rate for each of these days. So therefore, now in this particular first cash flow exchange, now that exchange would happen on 5th September 2022, right? On that day, the LIBOR rate is 4.8. LIBOR rate is 4.8. So, what is the amount Intel would pay to Microsoft? So that is 100 into 4.8 divided by 100 divided by 2. That would be the payment of Intel will pay to Microsoft. So what is that amount? 4.8 divided by 2. That is 2.4. That 2.4. Yes. 2.4. Now just look at these things. Now the agreement was made on this day. So therefore the applicable rate for the next payment would be 4.2. 4.2, is it? Applicable rate for that payment would be 4.2, not 4.8. Right? Anything? Any issue? Any issue? Right. Now I'm asking a very simple question, right? In the first cash flow exchange, who would be advantageous? Microsoft or Intel? Who would be getting an advantage at the first cash flow exchange? Yes.
Intel.
No. Sorry. Yeah. Intel would be advantage. Yes. They would be in advantage because they will pay only 2.1%, not 2.4, right? As I told earlier, because the applicable rate would be 4.2. So 4.2 divided by 2 is 2.1. So then that is the rate, or that is the amount they pay. Intel pay only 2.1, whereas they will receive 2.5. They will receive 2.5. So then they are at an advantage. They are at an advantage. They are at an advantage. Therefore, they will receive a net amount of 0.40. Is it? A net amount of 0.40. Okay. Now, if you do the calculation for each of these days, you will find. Now, these are the floating cash flows received. On September 5th, 2.1 received by Microsoft, and they paid 2.5. March 5th, 5th of March 2023, floating cash flow received was 2.4 and they paid 2.5. But in the next year, September, that is 5th of September 2023, floating cash flow received was 2.65, whereas they paid 2.5, and they have got a positive net is 0.15. Likewise, now after all, I mean, after having all these things, because this is a 3 years SOP, therefore this should go for 3 years. It should go for 3 years. Now after going for 3 years, you can see the net amount. So at the end of the day, the institution who has received floating flow cash flow would be positive. They would get a positive cash flow, net positive cash flow, and the fixed cash flow paid per person would have a negative. Is that okay? Because now all these things depends on the movement of LIBOR interest rates. If LIBOR interest rates have gone down, then the other party would be in advantage. The party who pays LIBOR would be at an advantage if the LIBOR rates are going down, have gone down. I think you got my point, is it? Yes, anything else you need to clarify here? Now, have you got the things correctly? Now, then later on, I will tell you why we have just arranged this type of mechanism. This is what you call fixed floating swap. And we call it a pay fixed, receive floating interest rate swap. Pay fixed, receive floating. That is one side. The other side also the other way. Pay floating, receive fixed. Right. I'm just asking you, in the point of view of Intel, what type of a swap is it? In the point of view of Intel, what type of a swap it is? Point of view of Intel, right? Just tell me.
Pay floating, receive fixed.
Pay floating, receive fixed. Yes, correct. In the point of view of Microsoft, pay fixed, receive floating. In the point of view of Microsoft. I think it's very clear. It's very clear. It tells about how the interest rate is paid and how the interest rate is received. Now, just look at it. The cash flow, net cash flow, either it could be a minus or plus, depends on the movement of LIBOR rates. Do you agree with that? The movement of LIBOR rates would decide that. If the LIBOR rates have gone down during the period, then what would happen? The ultimate net cash inflow outflow would be higher. Now, pay fixed receive floating means, now in the point of view of Microsoft, they would get a positive cash flow ultimately. Why? Because the LIBOR rate has gone beyond 5%, gone over 5% during the period. And invariably, they got a higher, or they got a positive net.
Sir, what would be the underlying asset here? The 100.
Yeah, underlying asset, as I told you earlier.
The notional.
Virtual, yeah, notional amount would be the underlying asset. Yes.
Not the interest rate.
Yeah. The reason, I think you are I think repeating your question, that what I want to tell you is this 100 million, though we have not, it is not a tangible one. What I want to tell you is that the purpose of getting this underlying asset is only to facilitate the calculation of interest. That's all. Nothing else. We don't exchange it physically. It's only a virtual type of a thing, an intangible. That is the nature of underlying.
Okay, sir.
Right. I think this particular thing now you got at a certain level of understanding, and here the party who would end up with a positive net would be Intel, Microsoft, because they get 6-month LIBOR floating, and their LIBOR rate has gone up. It has gone up beyond 5%. So therefore, from the third cash flow, they have got net positive. Who got net positive? Microsoft. Microsoft got net positive from the third cash flow, and I can just give the amount also. That is say 5. Yeah, they got 0.65 million as their net gain. Microsoft had a net gain of $0.65 million through this swap arrangement. At the same time, the other party, the Intel, they had a negative gain or loss of 0.65 million. So then this is a zero-sum game. One party's profit is the other party's loss. This type of things are called zero-sum games or zero-sum activities. Okay. Then you might ask me why this Intel or whatever should come into this type of agreement. They would have thought, rather than increasing, the LIBOR rate would come down. That is why they have come to this agreement. Because at that time, at the beginning, the LIBOR rate was only 4.2. And at the initial point, it looks like advantageous for the person who receives fixed. Right? Person who receives fixed would be at an advantage. That at the beginning, that is the on the face of it, that can be seen, is it? But at a later stage, what has happened? The LIBOR rate has gone up. Now you see the point, no? So for any investment, you would have to face with this type of movements. You are not in a position to predict if the things being predicted correctly by Intel. They would not come into this agreement. They would have thought that the LIBOR rate would come down in the coming 3 years. Or there would be another thing which can happen. They have just hedged some other type of interest payment. That may be a reason. Can anyone guess what it is? Can anyone guess what it is? This arrangement is being made for that, not for mere receiving of interest or paying of interest. Something else is in their mind. Now, first of all, are you clear with the intentions of Microsoft? They would have thought in time to come, because now at the beginning also, the LIBOR rate is lower than the 5%, At the first day, it was only 4.2. They would have thought it would further go down. No, in the next month it might have gone up, but in the subsequent months it would have gone down. That might be the thinking of Intel. That might be the thinking of Intel at the time of coming into the agreement with Microsoft. You got my point. But do you think that any company or whatever knowingly getting a loss? But there can be something else here. What would be that? I don't know whether you are getting what I am asking. Do you have any sense on this? Then what else the Intel people to come into this agreement? What other type of things which have been looked at by Intel and entered into this contract? Yeah.
they may have invested in a floating interest gaining asset.
Yeah, very good, very good. Yes, yes, that might be the reason. They are receiving floating rates. That is why they have come to an agreement to pay floating rates. Then they can just directly route those things to that payment. And they receive 5% fixed. And if you just look at it in that manner, they have done a certain hedging operation. Because now, say, it's like this. They might have, got as their receipts LIBOR plus something. Then they might not, in reality, they have not lost anything. You got my point? They have not lost anything in that case. Because if they received LIBOR plus 1% or something, right? That 1% is for them, no, however, right? Then they have a profit on that. Have you got my point? Say, for example, Intel might have received from their depositor, from their borrower, some borrower, say, who paid for $100 million loan, who has paid six-month LIBOR plus 1.5%. 6-month LIBOR plus 1.5%. He would have received, right? Then that cash flow he has routed to Microsoft, right? Then they have made a profit of 1% there. However, what do you say? And at the same time, they have paid 5% the other side. So, Microsoft paid 5%, right? Now, they would have received 6% fixed, but they have paid only 5%. And they also made a profit of 1%. So that would be maybe a reason. I don't know whether you got my point. Is it clear? Is it okay? Is it okay?
Yes, sir.
Right. So these are the reasons on which the people get into this interest rate swap type of transactions. Because the value depends on interest rates, fixed or floating. But fixed rate, it doesn't matter, because floating rate, you don't know in what direction it might go. But there are analysts who can predict on interest rate movements for a period of 5 years. Like, if the predictions are correct, then they would get the proper results. But in this particular case, Intel might have got a prediction to say that the LIBOR rates would come down in the near future for 3 years. Like, but that analysis or that predictions were got wrong. That is the reason. But nevertheless, they would have entered into this contract because they received a floating payment which is higher than what they have paid. Then their margin is assured. Their margin is assured. The 1% margin is assured, is it? Since they receive that amount. Yes, anything else you need to clarify? Now that is all about swaps, but the next stage would be to show you how a position, interest rate position in a bank or another financial institution would be converted by using an interest rate swap. Now in that conversion, the bank would try to have a constant margin by doing that swap. Constant margin. Then irrespective of the movement of interest rates, they would get a constant margin. They would get a constant margin. And in the case of deciding the notional amount also, this matter is there are several implications on the decision of notional amount. That notional amount might be always should tally with their number of total amount of borrowings or total amount of deposits or total amount of loans. That is how the things been arranged. The notional amount is that. Say for example, you want to hedge floating rate deposit of 100 million because you have to pay that floating rate deposit. So it may be you pay LIBOR minus something. If you do a transaction to receive LIBOR, then your payment is LIBOR minus 1%. Then you are getting 1% from that. Is that okay? So that is how the things been arranged. In Sri Lanka, these things are happening very frequently. Very frequently the swaps are being arranged. Most of the time between the banks. And sometimes some merchant banks and all, they try to arrange these swaps with commercial banks or whatever. Now it's like, in interest rate risk management, this is a very, very famous and very frequent type of an arrangement, hedging of interest rate risk. Today we have gone through several parts of derivative transactions, but basically what I need you to do is just look at these things again. And I told you at the beginning that there are four main types of derivatives: forwards, futures, swaps, and options. And under each of these categories, you get several types of derivatives. Now, for example, if you go by the forwards, you have forward exchange contracts, forward rate agreements, forward sales agreement, forward purchase agreements, and so on and so forth.
So,
Yeah.
few years back we had a hedging issue.
Yeah.
What do you think the error was? What was?
Right. That's a very famous and good question. That was in 2008 or 2009, if I remember correct. What happened was the CPC, they just engaged with some bank and did the hedging. So that hedging was a, options. They used option for that hedging. Option is another type of a derivative. Now what happened was they just went through a certain type of option where it's like this. Now for an option, you have to pay a premium. But this option, they have not asked to pay a premium. But what happened was the option price, the strike price was a higher price. But with the attitude or with the opinion that oil prices would go up rapidly, they did that hedging operation. But unfortunately, what happened was, after doing that operation, the oil prices have come down drastically. Then the option becomes out of the money option. That was the reason, very reason.
A wrong decision, is it? Wrong forecasting.
Yeah, wrong decision in the sense, now they would have thought that why these people have come with the zero cost option. Because for an option, invariably the option buyer has to pay a premium. That premium was a very low amount, and it's a zero type of a premium. Actually, no, I'm not going to boast about ourselves. I was at the Chief Financial Officer's department at that time in Bank Oslo. We also got the proposal. We point blank said no, because we found that if a premium is if an option is offered without a premium, something behind it, that's what we thought, right? So then therefore we were really escaped through that. But later on, some of the banks were in trouble because of that hedging operation, right? So that's what I told you. If you have a view of something, if that view goes wrong, you will be in trouble. All these hedging operations, it would happen. Basically with options. You got my point now? That was a drastic.
Yes, sir. Yes, sir.
Loss, yes. Since we had first-hand experience, I can just explain you what it is. It is not me that refused those things, but I have gone through that paper. We have gone through that paper, and our people have point blank said no. We are not going to deal with that. Then I just read later on. At that time I was in India, so I just went for a training program in India, NIBM. When I read the papers, I found that someone said the smart Bank of Ceylon just escaped from the deal. That was the news item. Right. Anyway, now I'm just telling you these things because in order to just avoid the boredom and all that. Otherwise, now this would be a very boring type of discussion, you know. And there's another question. Samit has given a question of what is option? Is it a hybrid? Yes, yes, of course, yes. It has the features of a swap and option both. That is what you call a swaption. And next time I will just get an example of the same nature, right? And then you will be more enlightened on that. Okay. Anything else you need to clarify? Anything else? Yes, Samit? Asanka? So at the beginning, I just I have seen about 9 to 10 persons here, but now it's only 5. But, my request for you is to just be with us and engage actively in the discussion. So that is the most important thing, rather than going through notes or whatever. Because you can clarify anything face to face. And I really appreciate your questions also. Because now when you ask something, it shows that you have a real interest and you have grasped something. So others also should engage in that manner. And you all can get a good benefit from this. Yes, anything else you need to clarify? Yes. Any more things to be clarified? Another type of an a derivative we need to just go through. Next time we will discuss, I mean, comprehensively on options, because options is the most important type of derivative in my opinion, because it really leads to several complications. Because of that, option can be taken as a very, very critical type of a derivative. So therefore, I will just discuss comprehensively on that. So with that, I wind up the session. And thank you very much, all of you, for your active participation and your questions. And I really appreciate that type of questions and queries. And even I really appreciate and really encourage others also to do that in a very, very active manner. So with that, thank you very much, all of you. And we will meet again on next Saturday. Thank you.
Thank you, sir.
Thank you, sir.
Thank you, sir. Thank you.